If you care about economics, investing, or simply want to understand how the world actually works behind the sensational headlines you see every day, then I ask you to watch this video all the way through. Don't stop halfway, don't skip ahead, because if you only hear part of it, there's a very high chance you'll walk away with the wrong conclusion, just like most of the market does today. And if you find that this kind of content helps you see things more clearly and more deeply, subscribe to Ascend Your Mind right now, because what we're talking about today isn't just about the present, it's about the cycle that comes next. Recently, a video gained millions of views with a very compelling argument. That video claimed that AI is not a bubble. The reasoning sounded simple and extremely convincing. AI isn't built on borrowed money. It doesn't rely on financial leverage. It isn't inflated by speculative retail capital the way the dot-com bubble was in 2000 or housing was in 2008. Instead, AI is being funded by real cash, surplus capital accumulated over many years by large technology companies. And by classical financial definitions, a bubble is something inflated by leverage. No leverage means no bubble. That argument is correct, and I agree with it. But here's the problem. Agreement is not enough. Because the moment we stop there, we begin telling ourselves, all right, then everything's fine. No bubble, no systemic risk. And that is the most dangerous moment in investing. Not when people panic, but when they are convinced they already understand enough. So let me ask you a very simple, very practical, and very difficult question to avoid. If a business operates using only its own real money, no debt, no leverage, no reliance on banks, can it still fail? The answer is yes, absolutely. But wait, don't answer too quickly, because the next question is the one that actually matters. If it fails, how does it fail? Does it create a massive explosion that drags down the entire financial system, collapses banks, crashes stock markets, destroys the economy? Or does it simply slow down, lose money over time, trap capital, and force the market to reprice expectations entirely? This is where most conversations about AI completely fall apart. Real money does not create domino-style financial crises. Real money does not explode. Real money freezes. And when money freezes, what happens isn't collapse. It's prolonged repricing. This isn't theory. History has proven this again and again. After the dot-com bubble, not every tech company disappeared. Fiber optic cables, servers, telecom infrastructure, they all remained. But trillions of dollars in invested capital were trapped for years. Stocks didn't go to zero, but they also didn't return to their previous highs for a very long time. That wasn't an instant explosion. It was a slow process of paying with time. So now, let's return to AI. If AI is built on real money, that tells us one thing. It's unlikely to trigger a classic financial crisis. But it does not tell us that it will generate value proportional to the money being spent. And this is where we need to step back and look at the bigger picture. AI is not the first time humanity has poured real money into a promise of transformational change. Economic history is full of future-defining mega projects: railroads, electrification, telecommunications, and eventually the internet. They all shared three characteristics: enormous upfront capital requirements, very long payback periods, and funding driven by real money, not short-term leverage. And in every one of those cycles, there was an uncomfortable truth. The people who invested earliest were rarely the ones who made the most money. Railroads unified the United States, but countless 19th century railroad investors went bankrupt or barely broke even decades later. The internet changed the world, but many early 2000s tech stocks took over a decade just to recover their previous highs. The question is not whether the future arrives. The question is where you are positioned when it does. How many people made money building the railroads versus how many made money after they already existed? That question may sound distant, but it is exactly the question we must ask about AI today, because AI is not just a product, it's infrastructure, and infrastructure has one defining trait. It requires massive upfront investment, while returns are distributed unevenly over time. This leads to a far larger consequence, one the market is largely ignoring. When hundreds of billions of dollars of real money are locked into chips, data centers, and AI compute infrastructure, that capital is no longer freely circulating in the economy. If real money is locked here, What isn't getting funded anymore? Every dollar committed to AI is a dollar not flowing elsewhere, not into other sectors, not into other cycles, not into other opportunities. And when capital priorities shift, markets don't collapse. They reprice, quietly, slowly, and over long periods of time. This is opportunity cost, the concept that headlines never talk about, but long-term investors cannot afford to ignore. And here's the part that needs to be said plainly. Big tech can wait. Individual investors cannot. Large technology companies can absorb years of losses. They have other cash-generating businesses. They have scale. They have time. Individual investors do not have that luxury. You can be right about the technology. You can be right about the future and still lose if you're right too early. Can you afford to be right, but too early? Can you afford a decade of underperformance while waiting for the future to become the present? This is where many people fail, not because they are wrong, but because they underestimate the cost of time. And this is why AI forces us to change the way we ask investment questions. In the past, we asked, is this technology good? Today, that question is insufficient. We must ask, who is supporting this technology? With what resources? And most importantly, how long are they willing to support it? Because in a world of strategic capital, profit is no longer the only metric. Power, positioning, and time matter just as much. In a world of strategic capital, timing beats conviction. You can believe in AI, but if you don't understand the forces supporting it, you're investing in the dark. And that's why this video doesn't try to answer the question, is AI a bubble? We're answering a much harder question. What is holding AI up? And when that support changes, where will you be standing? So let's return to AI once more. If AI is built on real money, it tells us one thing. It is unlikely to create a financial crisis, but it does not tell us whether it will deliver returns worthy of the expectations placed upon it. So to understand AI's real risk, we shouldn't ask, is there a bubble? We should ask, what is supporting AI? And what happens if that support weakens? Right now, there are three very clear forces holding AI up. The first is balance sheet strength. Microsoft, Google, Apple, Meta, these companies are cash-rich, lightly levered, and generate massive recurring cash flows from core businesses. They can spend hundreds of billions on AI without facing immediate liquidity pressure. A company can lose money for years if it's rich enough. And big tech is rich enough. But history teaches us something important. No leverage does not mean no risk. After the dot-com era, real money built telecom and fiber infrastructure that still exists today. But many investors waited 10 to 15 years just to break even. Real money didn't explode, but investors still lost time, capital, and opportunity. No leverage, no collapse. But was it a good investment at that moment in time? The second force is geopolitical and far more decisive. AI is not just an industry. It is power infrastructure. It touches national security, military advantage, data control, and global positioning. In a world of US-China competition, no major power can afford to fall behind in AI. This transforms AI from a purely economic investment into a strategic one. And when something is tied to national interest, the standard of evaluation changes. The question stops being, is this profitable next quarter, and becomes, are we allowed to fail at this stage? Right now, the answer is no. The third force is the monetary cycle and liquidity expectations. In periods where markets believe interest rates cannot stay high forever, long-duration growth assets are favored. AI sits at the center of the future growth narrative. It doesn't need massive cash flows today. It only needs to be believed to be critical 5 to 10 years from now. As long as that belief holds, capital stays. So let me ask one final question. If an industry is supported by massive cash reserves, geopolitical necessity, and monetary expectations, what could actually cause it to fail? Not a disappointing earnings report, not a critical article. AI doesn't collapse from bad news. It only fails if its support systems weaken together. If big tech is forced to cut spending as core profits decline. If geopolitical priorities shift to something more urgent, if monetary conditions stay tight longer than markets can tolerate, when that happens, AI doesn't explode. It gets abandoned. And in modern finance, abandonment is the most dangerous form of collapse because it's slow, quiet, and corrosive to capital over time. This is why this video is different from most of what you see online. We're not saying AI is a scam. We're not saying it will crash. And we're not saying it's a bubble to avoid at all costs. We're saying something harder to hear. AI is a strategically supported bet. And in bets like this, risk isn't about bubbles. It's about when support changes. If you're an investor, the real question isn't, does AI have a future? It's, where am I positioned in the cycle of its support? And if you want to keep understanding how money, power, and cycles interact to create both opportunities and traps in modern markets, subscribe to Ascend Your Mind. We don't chase headlines here. We read the structure behind them. Thank you for watching all the way through, and I'll see you in the next video.